Good evening, everyone. It's great to be with you tonight. My name is Scott Lurie with F Street. Tonight, we are going to go through a couple of our multifamily offerings that are available for current investment today. Our Brown Deer investment is closing in the next 30 days. We're super excited about F Street BD2 and Village 43. And as well as talking about our second phase at the beautiful shores of Lake Michigan at Lakeshore Commons. We're going to run through two of our developments. We're going to answer any questions, and we're going to let you carry on with your evening. We've had a lot of requests to video record this, which we will be sending out tomorrow once the recording is uploaded. So if you had any additional questions or if I didn't get to your questions, we will do that as well as we will be distributing this to all those parties that couldn't join us this evening. As a quick background on F Street is an alternative investment real estate focused firm. We focus on providing long-term wealth creation as well as generational cash flow to our investors. We've been investing for 20 years in the real estate space, and we are so excited about our past performance as well as the future-looking opportunities that we have at F Street and those that we're creating. We continue to plant money trees. I've used this analogy since I was a kid of, Mom, where does all the money come from? And she'd always say the money trees. And our investments in multifamily and industrial assets are truly money trees. Once you make your investment, we focus on returning that capital to you, and you get lifelong distributions from the asset or until we choose to sell the asset. And once that happens, you get a final distribution. Our investment strategies cover three different verticals. We focus on multifamily and ground up and value add. We focus on the industrial category, ground up and value add. And we also have a private debt fund, which we'll talk about very little tonight, but our private debt fund is a 10% coupon fund. It pays 1/12 of 10% each month. I started the fund with $700,000 in 2009, and I'm proud to say today we're honing in on $100 million, and we're focused on growing our balance sheet to $200 million. Our team's not here. Well, they're here, but not on screen. Myself, I've got some great partners in investor relations team with Josh Lurie, Nick Young, as well as Mitch Ferraro. If you haven't had a chance to speak to Mitch or anybody on our team, we are open, transparent, and love talking to our investors. So feel free to set up a time to meet with us, talk with us, or ask any questions you might have. Our portfolio for multifamily spans several different geographical locations. We are a Southeastern Wisconsin-based firm. We've built brand new ground up in Sheboygan Falls, in Brown Deer, Wisconsin, in Oak Creek, Wisconsin, at the coast at Lakeshore Commons that just finished. We just reached 95% occupancy. We're under construction today on the Emory, and that color's not great, but the Emory is under construction. And we do also provide build value add. So we have taken the business approach that we're going to increase our value through buying Generation 1 residents in throughout the United States. And so we've bought 6 of those: Jackson, Mississippi, New York, Ohio, Texas, and Wisconsin. So we started with the idea of building Generation 1. So these were built in the late 80s. Marriott had them built for residents in. They were all built as townhomes, and we've converted those to apartments. And we continue to seek those opportunities as well. So a little bit of our development overview, as we touched on, we do continue to build industrial. We've got 531,000 square feet in the proposed pipeline. We've got 964,000 feet in progress right now, and we've already completed 1.2 million square feet of industrial. In the multifamily category, we have completed 845 units. We have 311 units that are in progress today, and we're proposed on moving forward basis in our pipeline of 674 units moving forward. We try to do 3 to 5 deals a year. We try to make those deals meaningful and powerful and impactful, and we want to deliver above market returns to our investors. So we're not a quantity investment firm. We're a quality investment firm that focuses on delivering high quality assets, and that's our focus. We good? Village 43. Let's talk about our newest offering, Village 43, also legally known as F Street BD2, which is in Brown Deer, Wisconsin. Another one of our great developments. A little bit about BD2. We're projecting a 24.12 projected IRR based on a 7-year hold period. We have developed and completed and successfully leased up 134 market rate apartments directly across the street. That's the GreenLink residence that if you drove by there, you'd see them. We're at 95% plus occupancy, and 1/3 of our investor capital has already been returned. We'll talk about returning capital a lot. Our focus remains to deploy your capital and get you your capital back. That's always been our thesis. When I started with no capital, I always knew I had to get my investors their money back in order for them to do the next deal with me. And so that's how the evolution of getting investors their money back as quickly as possible was always an important thesis for us. Market strength. There's strong demand that remains in the village of Brown Deer, in the north suburbs of Milwaukee. And the village of Brown Deer is putting together 10 Mile Park, which is going to be a massive redevelopment of a park in right on the Oak Leaf Trail. And it's unbelievable. It's designed by the architects that have designed our multifamily building, Rinka. We'll talk a little bit about them as well. Equally as important is we've got a wonderful relationship with the village of Brown Deer. The village of Brown Deer, which we'll talk about, has provided us with almost $7.5 million of subsidy to make this project a go. That $7.5 million makes this an investment grade thesis that benefits the investors. It is a great win-win, and we're really excited to have the partnership with the village of Brown Deer. I forgot to mention, if you have any questions at any time during the chat, if you simply type them into the chat, Peter and myself will moderate those and share those back with the group. We will also have question and answer available for us at the end should we have any questions I have not been able to answer for you. So you don't have to hold your question. We might not answer it right away, but we want to certainly keep it top of mind. So F Street BD2 is a Class A development. We believe that our Class A developments are elevated Class A. We focus on the architecture, we focus on the amenities, we focus on the value creation, and the most important piece is we focus on the living experience because we want to make sure that the occupants, the people that are living there, stay longer. The longer they stay, the less friction we have on the property, the more returns we can drive. Very exciting is that we're building 156 market rate garden style apartments in the suburbs just north of Milwaukee. So this is happening. We're scheduled, which we'll talk about, to begin construction in September. Our construction timeline is 8 to 14 months, and our first unit should be available for lease in 10 months. So we're working really hard to get this timing done. The first units might potentially be done and at least available for lease in 8 months, but we'll see how everything works. But we're putting a little factor of availability of construction delay in there, but we believe that we'll be completely with this project in 14 months. The efficient leasing, we haven't talked about our partners at Harmonic, but we partner with Harmonic Residential. They're an unbelievable management firm, best in class. They've leased up all of our other properties and currently manage all of our multifamily assets in the state of Wisconsin. They're a wonderful partner. They will start pre-leasing 6 months prior to opening. So 2 to 3 months into this development, we're going to start pre-leasing the first building. And that first building will begin cash flowing in 8 to 10 months, which will be bringing in cash flow, which is a really unique and really exciting opportunity here. Upon stabilization, we plan to refinance this to maximize the returns and to preserve the cash flow until the asset's sold. So we're looking at that point in a forward-looking 24 to 36 months from now, we will be looking to refinance the asset, repay the investor, pay the preferred return, and from there, we're looking to then distribute the cash flow to continue to reduce the owed dollars to the investors. And then once stabilized, we plan to distribute cash flow to our investors on a monthly basis. GreenLink has 95% occupancy. Since its 24th month, we've been distributing cash flow to its investors without a single hiccup. We've never missed a payment. We never have paused distributions. We every single month are making those distributions because we're focused on the management and the cash flow to be able to distribute and execute on our business plan. So let's talk about the results. What are we thinking about here? What's happening? 24.64% based on a four-year hold period, refinance in year 2, and our assumption is at a 5.5% into an agency loan, and we're also exiting a sale at 5.5 on a cap rate. So if you believe our thesis that we can get to a 5.5 cap rate, we're going to be at 24.64. If you think our thesis is going to be a 5.75 or a 6, we're going to be below that. We're pretty confident in our ability that this multifamily Class A will sell at a minimum of 5.5% cap rate. We also believe very confidently that with any reduction in interest rates, we will be able to get into agency debt at 5.5. So right now, our agency debt that we're running into, that we're seeing right now, is about 6%. So we believe that with a little bit of cut in rates, which are forecasted but not potentially happening in 2024, that should happen in 2025, and whether it's 100 or 180 or 150 or 200 basis points, we're not 100% sure what it could be. We're confident in our ability to execute on the refinance in year 2, and we believe that our capitalization rate on the sale is 5.5%. Our yield to cost is 7.89%, based on the projected year 1 NOI and incentives. That is a major win. That's a great number. We're proud of that. And then the equity multiplier after year 4 is 1.96, or essentially two times. So if you invested today $100,000 in 4 years, we plan to have you double your money back. Once again, based on those projections of 5.5 and 5.5. If that gets better, you do better. If it gets worse, those numbers will come down, but we believe highly in our ability to deliver on those numbers. So we talk a little bit about our partners. We have identified and are working with Greenfire. They're our construction management services company. As I mentioned, Harmonic, and I also mentioned that Rinka is our architecture partner on this transaction. We've had great success with the Rinka team. We've had great success with Harmonic, and Greenfire has really been building a great reputation and legacy for them in Southeastern Wisconsin, and we're excited to work with them on this project. So here's a couple renderings of what this will look like. In this right here, this is our clubhouse amenity. You will see the clubhouse. We'll talk more about the amenities in a minute. We'll talk a little bit about some of the architecture in a minute and some of the other internal and external amenities. But take a look at the balconies. Take a look at the entrances, garden style. Each person has a front door to walk into to call themselves home. Garden style has a little bit longer longevity of people staying a little bit longer because it's a different type of living. So let's talk a little bit about the submarket analysis for Brown Deer. Brown Deer is a village within the Metro Milwaukee area. For those of you who are not from the community, it's a submarket. It's a northern suburb of Milwaukee. For those of you that are in Milwaukee, I'm sure you all understand and know where Brown Deer is. We have had really great success with Brown Deer. There was Right Height. Right Height has moved, but there's FIS Global that is a large employer in the area. There's also several other employers, Badger Meter, as well as several others that are surrounding the location. There's limited housing other than our Greenlink project, and the Bevy. Other than those two projects, there hasn't been a new construction built in Brown Deer since 1988. So when we built Greenlink, we knew there was a high demand because nothing has been built since 1988. We also know that there's demand through our market study for continued development in Brown Deer, Wisconsin. In addition to that, there is with the increased demand also comes with some rent growth. And then community focused. So the village of Brown Deer is really focused on the village and their public amenities, and those are really great for the development. 11-mile park, 10-mile park is a mile marker off of the Urban Trail, which is a bike trail that runs all the way up to Sheboygan, Wisconsin, and there's going to be an unbelievable amenity for the community and for those folks that are riding on the Urban Trail. Demand drivers, we are only 20 minutes from downtown Milwaukee. For those people that wanted to live outside of the suburb, but wanted to, for those of you that don't want to live in the city but live in the suburbs, this is a great option, and we see tons of demand. Greenlink is a great case study. We've got great numbers from Greenlink. So the proven market, I keep talking about Greenlink, and you probably are wondering why. And the reason is it's been a great success. We had a 16-month construction cycle. We are 95% leased within 8 months. That means that demand for the area, housing in the area was at a high demand. We got to 95% leased up in 8 months. That is an unbelievable victory. And at the time of refinance, 100% of preferred accrued was paid. 100%. We've paid everybody their preferred return, and it's all been paid. So we are current with our investors as we continue to pay. And there's a 4-year payback post refinance of the investor's equity, which is your cash dollars that you paid to be an investor. And investors, this to me is the most important part of this. Investors retain their equity. You always own your equity. We don't trade your equity. There's no buyback. There's no clawbacks. There's no nothing. Once you make your investment, once you become an owner, you're an owner. You get the benefit of being an owner forever. The tax benefits you get from day one when we build the buildings, and the cash flow benefits you get for the life of the building, so long as we own it or until it is sold. So let's talk about the structure of investment. If you made it a $200,000 investment, you get 1.72% of the Class A. You get a preferred return of 8%. And so let's talk about it. You get 8% preferred return on outstanding dollars. So every dollar you invest earns you 8%. It's accruing for the first 24 months. I don't have cash flow from the property because I'm building, developing, stabilizing, but you're earning it. So if you put in the money, we'll owe you that money. We will pay that to you first before we pay any of your principal back. 100% of the free cash flow goes to the Class A members. You, the equity, you, the investor, 100% of the cash flow goes back to you until you're paid back. So think about it. All I'm incentivized to do is maximize the return, drive NOI, and get you paid back your money. Once you have your money back, we then split 50-50, but not until you have all of your money back. So once you have all of your money back, we participate. Not until 1 minute before that, not until $1 before that. You always have your money back before we participate. So that gives you the incentive to know that I'm focused on getting your money back because I want to share in the 50-50 cash flow, but I can't do that until I've paid you back all of your money plus your 8% preferred return. So we have an investor cash flow statement right here. The numbers are a little small. I want to share this with you because the only reason I want to share it to you is that this is available to you, and it's in your offering memorandum, or you can find it at fstreet.com. We have a sensitivity analysis down here that goes through the various different exit refi cap rates, which discusses the various different IRRs that can be available to you and the different cap rates associated with it. Please go through this. It's important. It's great stuff. Maybe this is more exciting to me than some other people, but this is really exciting stuff. We also discuss what your $200,000 investment looks like and how it returns to you $392,000. That's the multiplier that we discussed, the 1.96. So take a look at these numbers. These are great alternative investment numbers. These are great opportunities for investment. This is real numbers. These are numbers that we are very confident in delivering on. So a lot of people have asked what's happened with the capital markets and what are we doing with this transaction. We are very proud of our partnerships with all of our banks. We have had a great 20-year plus relationship with all of our lenders, and we continue to do so. First American Bank has provided us with a $26 million term sheet. And yes, that says 70% loan to cost. They are providing us with 70% leverage to cost, which is very unique in today's world. That is a great victory for us. All of us. We get 36 months. On the first term, we have 2 years options to extend. We're paying SOFR plus 295, and it's interest only during the entire term. So if after month 24, we're stabilized and the capital markets haven't softened, I got 3 more years in this same term, and it's interest only. That's the downside. That's the worst case scenario. So we're protecting the worst downside scenario right here with this extension, right? This extension right here, the 2, is what gives us a lot of comfort. We believe the capital markets will ease, but you can't believe it until you see it. And so we want to protect us and everyone involved. So we talked a little bit about a TIF. For those of you who don't know what TIF is, TIF stands for tax incremental financing. And municipalities created a TIF, or tax incremental financing, by creating a TID, which is a tax incremental district that has money available to provide for development. And in exchange for the taxes, you get to have that money back. And so the village is providing us with $7.45 million over 21 years. That is unbelievable. This is a huge victory for us. 21 years, $7.45 million. And by way of providing it to us is that we don't have to pay property taxes for the 21-year period in theory, right? There's different percentages that are along with that, but I'm giving you a high level of it. We have a developer agreement, and the nice part of that agreement is that it goes with the project. So if we go to sell this, the TIF stays along with the project. That gives us value, which gives us the ability to sell it for a higher value. Okay. Any questions about GreenLink before we jump into Summit? We have a couple questions, Peter. Yep. So the 24.12 that was issued prior to it was a pre-construction IRR. The 24.62% IRR is the accurate post-construction stabilized 4-year exit number that's there. Those numbers have little movement by different deltas of stabilized, unstabilized, completed of construction, and then the year of the exit, 1, 3, 5, 7, 4 in this scenario. That was the discrepancy there. So the IRR is accurate at 24.62. The second question is, the minimum investment is $50,000 into this transaction. It's only available for accredited investors. We do solicit through the 506C, which is general solicitation under the SEC guidelines. And as a result of that, we do require a third-party accreditation process, which is relatively simple. It's integrated completely into fstreet.com, and we'd love to have your investment in BD2. So the question is, what are the remaining steps that need to happen before Village 43 breaks ground? That's a great question. So we are prepared to call all capital on August 15th. So 2 things have to happen. We have to complete our equity raise, which we're doing right now. We have been very successful in the past 48 hours in raising dollars. We have soft commitments. We have a few investors that have committed to, one of our larger investors just committed to $2.5 million of that dollars. So we're raising money in a pretty efficient fashion right now. Demand for alternative investments in real estate continues to remain high. We have some discussions next week with a few other investor partners. But the reality is that we need to raise the equity, which we're confident we're going to be able to do. And then we need to close on the land. We already own the land. We need to close on the construction loan and begin construction. Our intention to do that is to call the capital on August 15th and to close on the loan and begin construction on September 1st. Other than approvals, we already have all of our approvals and municipality approvals to move forward. So we are prepared to move forward at this point. We've got some technical items that have to get completed, but those will not stop a September 1st start date. So the question is, are the rate cuts projected in the IRR? They're projected in our assumptions on the cap rate exit, right? So we're projecting a 5.5% exit on the capitalization rate of when we sell the asset. That's projected in there, yes, but that doesn't impact the Fed's rates. Our interest rate on our refinance is projected at 5.5%, and that is directly correlated to the Fed. And we have priced that in, meaning we are making the assumption that we will be able to achieve a 5.5% refinanceable rate with an agency in 24 months. So partly yes, partly no. We do think that multifamily will remain strong. In the throes of it, there was deals trading sub 4% cap rate. We still see deals trading at crazy numbers today. So we feel conservative in the 5.5% cap rate on the exit as an obtainable and achievable number. Another wonderful question, one of our favorite questions: how does depreciation work for the investors? So we are all about the tax benefits. We know that to be an investor, one has to also capitalize on the tax planning and tax benefits of real estate. And it is so important to us. So in these particular deals, or all of our deals, we do a modified form or a form of a cost segregation study. On a new construction, it's a 179D, but on an existing building, it's a cost segregation study. They all yield the same result, which is a bonus depreciation or an accelerated depreciation to get your basis down to zero upon investment. We will do that in the first year of stabilization, of completion of construction. And so we are all about tax savings, tax planning, and you absolutely will get your share of the depreciation. And we love that more than anything and are super excited every time we can share that with our investors. So the equity raise is 30%, the debt 70%. So we have a 70% loan to cost, and we have 30% equity that's being raised. Yep. So winter conditions have to be contemplated since we live in Wisconsin. And the question was, how do winter conditions impact this development? So a couple things to consider. On this particular development, we are not going subterranean. We are not going underground for parking. We are at surface and garage parking, all at surface level. So we don't have to contemplate tremendous amount of winter conditions. We do have some winter conditions that are contemplated in some of our slab pouring that'll happen in some of the other buildings. With that said, we've already factored that into our pricing with Greenfire, and it will not impact our budget, as the budget is already fully baked, and we are 100% confident that we will come in on budget as well. Okay, great questions. I love an engaged crowd. I love engaged investors, and I really appreciate you participating. We're going to run through Summit. Summit is F Street OCLV MF2. This is a round 2 of our great success at Coast. And this is in Oak Creek, Wisconsin, on the beautiful shores of Lake Michigan. We plan to build 132 market rate apartments. The projected IRR is 20.48 on a 7-year period of hold. Phase 1 is 6 months ahead of schedule in our Coast development. So Coast is the 199 units that's just to the east of this building, just so people don't get confused. Coast exists, 199 units already built. We're at 95% leased. We are 6 months ahead of schedule, and we plan to deliver to investors distributions Q3 of this year, only 18 months after the construction began. We are really excited about this project. It's leased up. This is one of those projects that is on the beautiful shores of Lake Michigan that's going to continue to appreciate in value, and we're continuing to do amazing things in Oak Creek. This project, Oak Creek, Lakeshore Commons, is legacy investment, legacy money tree, unbelievable opportunities, and we're really excited about this. We've got an unbelievable strong relationship with Oak Creek. You'll hear that often in what we're saying. We build relationships with the communities that are interested in having us do work there, where we can continue to be partners with them and be successful. So we talked about F Street OCLV. Here's a map. This entire development right here is 66 acres. Okay, so this is 66 acres of development. Okay, what we've built right here is Coast. So this is Coast. That's the 199 units, and that's already developed. We're at 95% developed there. Occupied. We're doing great things there. It is amazing. Please go drive down there if you haven't. If you haven't been there, I've got great video I can show you if you're not in the area. We are under construction on Ivy right now. This is 28 townhomes. Okay, the 28 townhomes are under construction. They'll begin renting in August, which the first occupants will move in. It just went up for lease. We're having great interest in those units. There's only 28 of them, and those are almost done. Right here is amenity package. There's a pool, clubhouse, pickleball court, tennis court, basketball court, parking. And then in addition to that, there's all of the various parks. This is a beautiful park. There's over 9 miles of walking trail, and there is so many amenities in this park that people are loving living at Lakeshore Commons. What we're discussing right now is Summit. This is Summit right here. This is going to be the 132 units. Construction's 12 to 14 months in timeline. First unit should be available after 10 months. Pre-leasing will start in 6 months. We plan to do the exact same thing. We're going to build it. We're going to lease it. We're going to stabilize it. We're going to refinance. The investors get the same thing. All ongoing monthly cash flow until all of your money's repaid, and then you'll continue to get monthly cash flow until we sell the asset and that might be in 3, 5, or 7 years. So let's go through the numbers. Here's what we're projecting. 20.48 IRR based on a 7-year hold period. We are projecting a refinance in year 3 at 5%. So here we talked about the Fed rate. We believe that rates will go down in 24 months based on when we're starting this, and we should be able to hit a 5% rate with agency. So there is a 5% reduction. We have kept the sale cap rate at 5.5, and we have a yield on cost at 6.84 projected on year 1 NOI with a multiplier of 1.94 based on a 7-year hold. So 5% agency loan, 5.5% cap rate. So those factor in terms of the equity multiplier is obviously the interest rate as well as the cap rate. So we've got the same partners. We already addressed the same partners. We are working with a different construction company than Greenfire here. We haven't put them on here because we're still in negotiations with one final phase of it, but it will be, there's a very high probability it'll be the same builder that built Coast for us. We're really excited to work with them again. So here's some pictures of what the renderings will be. Our renderings look pretty good, but they look better in person. If you came out and saw Coast, if you came out and looked at what we're doing over there, the place looks amazing. It's my favorite place to go on Saturday mornings or Saturday afternoons. Check out all the beautiful amenities at Lakeshore Commons and take a look at our assets there. People are really enjoying living there, and our lease up remains incredibly high. So let's talk about an investment here. So same concept. We have a $200,000 investment. You get an 8% preferred return, 100% of the free cash flow until all of your money is repaid. And then in this deal, it's a little different. 60% cash flow goes to the investor and 40% goes to us as your partner. The other deal, as you referenced, was 50-50. And there's for sure going to be a question as to why that is the case. And the reason it is that if we weren't able to provide more cash flow to the investors, their returns would be below investment thesis for us. And we wanted to be sure we were in 20% IRR digits. And so you had to provide more cash flow to the investor to get to a higher IRR. That's the simple answer. It's math. We want to deliver results to our investors that are above market, and we want to make sure that we can do that. And to do that, we had to provide more of the equity to the investor. Simple. 8% preferred return, as we discussed, completed by Q2 of 25, tenants in place by Q3, with a refinance hopefully happening Q4. So we're optimistic about this transaction. We're about to execute on a refinance at Coast, which is the building that just got completed. We are waiting for the capital markets right now. And so we haven't pulled the trigger, but we believe that we'll probably be in a better place shortly. And that's why we are projecting a faster refinance on this project. So project partnership, Lakeshore Commons has already received tons of TIF financing from the city of Oak Creek. We've received $30 million of TIF to lay the infrastructure and all the horizontal infrastructure. So when people say horizontal, they're talking about everything from the roads and below. They're not talking about any physical buildings or any buildings that people would be living in. We do, on this deal, have a vertical TIF of $7.075 million, and it's over 19 years with the city of Oak Creek. Another great victory. The city of Oak Creek and their entire administration have been big supporters of F Street, and we continue to do great things together, and we really appreciate our partnership with them. We talked about the TIF financing here. We're going to talk about it one more time. We got $7.075 million payable over 19 years, and it's very unique. Over 19 years, we're getting a 95% tax rebate up to the 7.075. So if the tax bill is $100,000, they're giving us $95,000. They're only giving us 95% of it, and we get that for 19 years, which will equate to the $7.075 million. So we briefly touched on Village 43. Question? So the question is the 60-40 split after the 8% is caught up? The answer is absolutely. The 8%, it's a preferred return. So understanding how the waterfall works, it falls above the preference before any splits happen. So after the 8% is paid, after you have all of that money paid, that's when the 60-40 split commences. 100%. Great question. Yeah, so we're projecting a higher rate of return, meaning more actual dollars to the investors over the hold period in Brown BD2. I have a whole calculation for you that I'm happy to walk you through in the offering memorandum that shows the various different IRRs and how we achieve them. But what is all contemplated into them is all of the cash, the timing of the cash payments, and then the timing of a sale and the proceeds from the sale give you your IRR, right? So it's a time-sensitive analysis that requires you to take into account the investment and all of the aggregate returns, including all of the cash flow during the period of the time of the hold period that gets you to that point. So there's different investment theses, and one would say, well, then why would someone ever take an investment that's under 24 when you can get why would you do a 20 when you get a 24? And the answer is diversification. The answer is different asset classes, different geographical locations, different diversification, right? So all of that I'm happy to walk you through. It's all in our offering memorandum. It's complicated to do for me to articulate it over the camera to you over this webinar, but I'd love whoever asked that question. If you want to email me, scott@fstreet.com, I'm happy to set up a call with you tomorrow or anytime that's convenient for your schedule. I will walk you through all of the models. I'll open up our Excel workbook for you, and I'll show you exactly the difference, and we can start playing with the assumptions we're making, which will impact the IRR. So thank you for the question, and I know I didn't fully answer it, but I'd like to do so in a better environment where I can provide it to you. So the question is, 4 years ago in the heyday, what was a typical exit for F Street in terms of cap rate exits? So F Street is predominantly a long-term real estate investment holder. So we model out a lot of this for you, and we have to use a time-sensitive analysis for IRRs. The answer to the question is cap rates were getting crazy, right? In the heyday, you were seeing cap rates in the threes, low fours, sometimes even more aggressive than that, depending on 1031 money, which is exchange dollars from a previous transaction. So cap rates were ridiculous, but there always was a disconnect between cap rate and interest rate, which has always been an interesting paradigm to me, right? There's always been a disconnect, and the disconnect has been very, very similar, has been very disconnected only in multifamily. The other industries, such as industrial, have taken a much better, maybe a more aggressive approach to bridge the gap between the two of them, interest rates and cap rate, in terms of exits. So if someone were to be buying a deal today at 4.5% cap rate, they are underwater based on interest expense, and it's going to require more down payment to right size the loan to get to where you need to be. And a lot of that comes through the DSCR coverage ratios or other covenants that the lenders are providing you. But with that said, to answer the question, you were seeing as low as crazy numbers in the threes, and some, I would say, averaged in the fours. And this is all for Class A multifamily. Some of the Class C multifamily has been trading for 8, 9, 10, 12% cap rate. It just depends on the various different asset class underneath multifamily. Yep. So the question is the 8% compounded or is it a simple return? The answer is it's a simple return. It's 8% per year on your money until that cash flow gets going. It does not compound. And as a great segue into the next segment, F Street does have a private debt fund. I just want to mention this private debt fund for you because we talk about compounding interest, and Albert Einstein's eighth wonder of the world is compound interest, and we talk about this often. F Street provides a private debt fund, and it pays 10%. Okay, it's that simple. We pay you 10% on your money. If you give me $1 million, I'm paying you $100,000 a year. I can pay you $8,833 a month for 12 months. We do, as of 2 months ago, have just announced and released that we can now offer a compounding interest feature under the private debt fund. The PDR the PDF has the ability to offer compounding interest. So if you're an investor that wants the cash flow, take the money. If you're an investor that doesn't need the money for 5 years, try the compounding component of it. It's completely flexible. Your money is tied up for 12 months. All of our loans are secured by first lien positions. We lend your money to other real estate investors. As I mentioned, we started with $700,000. We have almost $100 million today. Here's a simple compounding interest that we talked about it, and we do reference Albert Einstein. Someone said he was pretty smart, and I probably agree with him. But if you started right here, year one, with compounding interest, here's what it looks like, year 5. And so you can see the significant material improvements in your position in terms of cash flow. And that's available to you as the investor at your selection. You can invest $100,000 in compound, $100,000 in cash payment. Either one works for us. We've got tremendous flexibility in the private debt fund, and it's a great vehicle. If you're not earning 10% on your money, ask yourself why. I've got hundreds of references, and we've done thousands of transactions. If you are not earning 10% on your money, you should ask yourself why. Because you have a conduit. You have stumbled upon this amazing webinar that has a conduit that's been in business for 20 years, that's been paying 10%. We've never missed a payment and never will. We've got safety and security inside of our business to allow to us always make this payments, and we're profitable. Doing business with people that are making money is good business. If they're not making money, they're not sustainable. We are making money. It's great to be partners with people that are making money. It's a weird thing to maybe say, but it's phenomenal to invest with people that are making money. Your money's protected. Yes, basically, the question is it basically a 12-month promissory note? Yes, exactly what it is. So if you put in $120,000, as we use this as an example, you have a 1-year investment. We're going to pay you $1,000 per month. Here it is, every month. You're going to receive a 1099 INT from us at the end of the year. You're going to get this on our portal. fstreet.com is an amazing conduit and ability for you to have that. And after your 12 months, it goes into what we call a 90-day two-way call provision. Why? Because at one point when I created this, I thought I was going to be able to get cheaper money than 10%. And the business worked so well at 10% that I was able to grow it to $100 million. And I probably should take away the two-way call provision and just say, ask for 90 days. But I still have it in there. So and maybe you can't teach an old dog new tricks. I don't know what the word is. But we continue to pay. So it's a 12-month promissory note. If you want your money back, you can have it back. We have a 95% retention rating. And the only reason people take money out is to pay for college, do silly things like buy boats, and every once in a while, buy homes. Other than that, people continue to add to it. And once you're involved in it, once you're part of it, once you see that every single month on the last business day of that month, you receive an ACH payment from us, you will too see that it works. So a little bit about the fund benefits. We've been at it for 15 plus years. We've never missed a payment. Here's loans written, and here's where we're projected to go. We do plan to just try to get to $200 million in the next 24 to 36 months. Last year, we paid $4.210 to investors. Every month, we're paying out a lot of money. And it happens every month. Never missed a payment. There's never been a mistake. Every single month on the last business day of the month, you get your payment. So in conclusion, before I open it up for any last final questions, I just want to say if you have not been to fstreet.com, if you are not a current investor, thank you for being here tonight. If you're a current investor, thank you for listening to me. I've always enjoyed talking to you guys. If you have not gone and earned your badge, it's an accreditation badge. It costs you nothing. It's a free service that we provide. And the SEC requires for you to invest with us under the 506C that you earn your accreditation. All that means is that a third party will ask you some questions. You will provide them with some documentation, and they will provide you with a letter that says, you are accredited. Once you become accredited, you're good for 5 years and you can invest on our platform. It costs you nothing. It's very simple. Most people get it done in 30 seconds. Some people, it takes a few days. But if it's taking you a few days, call me. I'll help you get through it, or one of our team members will. So with that said, I'm grateful to be here with you tonight. You can always reach me at scott@fstreet.com. Are there any final questions that I can answer for you? Yep. So the question is, any dip in loan production? So 23, the answer is we were cash constrained for a short period of time in 2023. We were writing a lot of loans that were out for demand. We had a credit facility that was growing, but as the capital markets were softening, our lending partner at the time paused. And since then, so we were at a $25 million facility with them. They paused. Since then, we now have doubled that. So we are at a $50 million facility with them. So we were able to cure the cash constraints that was causing us a little bit of internal pain, meaning we were having more demand but not enough liquidity. We now have more liquidity and we're in a great position to continue to grow. But our lending partner, which is CIT, who gets their funding from Allstate Insurance, and Wells Fargo, was kind of in the turmoil of what's going on with the rising interest rate environment and where the world's going. And so we had a little pause in 23. In 24, we will see volume probably come down a little bit, but our average loan, the amount of loans that'll go out will go up, dollar-wise. So interesting paradigm that's happening right now. We have exceeded 6 months of previous year of deployment. We should probably see somewhere between $70 and $90 million this year of deployment, which is a great number for us, and we're super excited about where we're going. Yep. So the question is, can you give a little more context about the Hard Money Co. and its rates, its fees? Yes. So when I started the business, so I'm going to back you up for 2 minutes, and I'm sorry this is going to take a little bit longer, so bear with me. When I started the business, I was a franchisee of Homevestors. So Homevestors, the We Buy Ugly Houses people. So in 2003, starting with nothing, I started flipping houses, buying distressed real estate. I became a franchisee. I was the first one in the state of Wisconsin, and I put up all these We Buy Ugly houses. But that didn't catch my attention. Yes, it was fun. I flipped 150 houses. Yes, I was buying houses every day. It was great. But what intrigued me was how all of the other people were getting their financing. And so when I separated from Homevestors in February of 2008, they became insolvent. They were eventually sold to the Doctors Group, which owns Subway, and since have sold, I think, to someone else. I was very fascinated with how they're lending money. And so I only had $700,000, remember. So I started with a simple premise. I'm going to pay you 10% and I'm going to charge 15%. And so I charge 15% interest. I charge 5 points of origination, and that's the business. It's very simple. And so everyone says, well, that's so expensive. That's a lot of money. Well, my borrowers, the ones that are doing amazing, are making $1 million a year with my money. Our money. The money. And so how bad can it be? They're making $25,000 to $50,000 a flip. They're making $50,000 to $100,000 a flip. They're making $50,000 on a refinance, and it's costing them $12,000. So the cost of capital, yes, it's more expensive, but what investors come to us for is time and convenience. So I have a loan that came to me on Friday for $1.885 million for an unbelievable opportunity, and we're closing on it tomorrow. And so those opportunities present themselves to us. Our average loan is under $200,000. We do a lot of transactions for fix and flip borrowers, and that's our business. But we do get those one-off deals that come through. Hey, can you close this for me? And we get aggressive with terms. We get aggressive with loan to values, and it works out. And so it's been an unbelievable run. The futures for private credit is only growing right now. Private debt is growing. It's really becoming a mainstay, and people are starting to pay attention to it. Those that are interested in it are saying, wow, this is great. We've got an unbelievable business. We have 580 some loans that you diversify across your entire portfolio on. So you don't have to worry about getting your 10%. You don't have to worry about your returns. Our business worries about collecting the money and managing the receivables and issuing the loans and getting paid off on the loans and managing the process. So it is an unbelievable business. It is a great business to be part of. And as a private debt fund, I'm really proud of everything we do here every day. All right. Well, guys, thank you for joining me. Once again, my name is Scott Lurie. I'm the founder at F Street. I'm grateful for your time. I know time is a commodity that we can't get back, but you've chosen to spend an hour with me tonight. I'm appreciative of it. I'd love to have you invest in BD2. I'd love to have you invest in MF2. I'd love to have you invest in the private debt fund. If you're not earning 10% and you've got money sitting, why? Let's get it working for you. We'd love to have you invest. We'd love to plant your money trees with us. F Street is a mighty team. We are nimble. We are focused on alternative investments and producing great returns for investors like yourself. Thanks for joining me tonight. I hope to see you soon. If you have any questions, reach out to me. I promise you I will call you back. Thank you for being here, and we will talk to you soon.